Hi, Matt. Thank you so much for coming on to the show today.
Hi, Anne. Yeah, privileged to be here. I love your podcast, which kind of got me into the whole HMO thing recently. So, very happy to be here.
Good. So this is quite new for us on the podcast today. Today we're going to do, I suppose, a bit of a mini mentoring session. So I'm quite excited about this and help our listeners know what to expect today. I've got a few questions that you've already sent over to me. I've had a good look at them. There's some great questions, and I think there's going to be a lot of really useful stuff that comes out of today's episode that will help many of our listeners. But before we dive into those questions, for the benefit of me, Matt, and for our listeners, can you give us a quick intro to you, what you're currently doing, where you are, and I suppose what your objectives are, what you're trying to get out of the HMO and property stuff?
Yeah, so I run a small building firm at the moment. I've been in construction for about 25 years since I left art college, weirdly enough. I've done a little bit of developing, a bit of flipping here and there, sort of around central London, West London. We moved out of West London. Now I've got 2 kids. We moved out of West London to Buckinghamshire recently, near Gerrard's Cross, and doing the building out here and just looking for something different, really. Getting back into property and doing it for myself, really.
Okay, books is obviously a nice part of the world, but not a cheap part of the world.
No, no.
So, I think that this is going to be quite a feature of today's conversation because I've seen the questions that you've sent over already, and there's definitely some stuff in there that I think is going to be pertinent when we think about where you're based in the country. So, let's get stuck into this. You've got 3 questions today, so let me just very quickly let our listeners know what those questions are. The first question that we're going to tackle is, are HMOs harder to do in the south of England? I live in Bucks, and it seems quite hard to get the numbers to work unless you go towards the 7+ rooms. For the refinancing and scaling model, what sort of uplift do you need to make this work? And then there was a part B to this question, which is how do first-timers actually get commercial valuations? So that's a great question. There's a lot of sort of meat on that bone. I'm looking forward to unpacking that today. The second question was, what should I be looking for when I'm sort of sourcing a potential HMO? I think I know that what type of buildings work, but I'm unsure as to sort of the area, the streets that would get planning, kind of how to actually figure out what would be better suited to families or HMOs, how the council would feel about things, parking spaces when it comes to planning, etc. So we'll unpack that. And the third question, if we've got time, was what tips do you have on approaching friends, family, and any other suitable investors, which is a question that I love to answer, and I'm glad that you've asked it. So let's get into the very first question. Are HMOs harder to do in the south of England? You live in Buckinghamshire, so it's obviously quite hard to get the numbers to stack up. And interestingly, I've actually worked with a couple of people who've been based in Buckinghamshire, so this, I don't know too much about books, but I definitely do know that it is quite expensive, and it is a real consideration when it comes to investment returns and putting capital down. So, Matt, can you give me an idea? What sort of prices, when you've been looking at potential HMOs, what sort of prices have you been looking at? What does it kind of seem to be on the market?
Well, I initially was looking at the area where I live because taking from your advice on one of your podcasts, I remember saying know your area and limit your area. So I thought let's start with that first. But it's quite a small-ish village, and it's the communications aren't great. So and after looking at the Buckinghamshire list of HMOs, there's probably about 2 or 3 HMOs in my immediate area, and I think 2 of them are above pubs. So that's probably a different thing altogether. So I've started looking in the 2 areas where they seem to be is like High Wycombe and Slough, where prices are a little bit cheaper. I'm kind of looking at that, get a 3-bedroom and turn it into I hope 5, 6, 7, kind of do the extension and loft conversion. That seems to be the kind of route to take. And I think you could, about 400, 450.
Okay.
You could pick up something decent for that.
Okay, so that actually doesn't sound as expensive as I was perhaps anticipating, but the devil's always in the detail. So when I sit down with somebody who is perhaps transitioning out of like a corporate career or coming from a different area of property and wants to get into HMOs for the first time, tackling that area is a really big part. In fact, it's one of the sort of 5 pillars of the roadmap. We've got sort of how to sort of find deals, funding things, and so on and so forth. But within the finding deals is actually kind of nailing our area and exactly where we invest. And to do that, we need to understand lots of things. Now, what I would suggest here is that the HMO model is so great because it's so flexible. It's so versatile. You can pretty much make it work no matter where you are in the country. However, we've all got our own criteria. We've all got our own investment metrics and framework that we need to work to, or certainly should be working to. And it's important that when we're looking at an area, we're keeping this very much in mind. And one of the things that I see people often do is actually try and figure out the area without first trying to figure out what they need from their investment. And it's sort of like trying to, throw two stones and into the air and trying to hit them. What we need to first do is figure out what a good investment, what a target investment looks like to us. So what I would recommend you start with here, Matt, is getting into what you want to achieve from your deals. To do this, you actually need to look a little bit further ahead at your sort of 5 to 10 year goal. I encourage people to think about what type of business or portfolio that they want. Do they want to be involved in managing them? These sorts of things affect what the portfolio will look like. Students, professional HMOs and social HMOs, they're all quite different. Where it's located, is that a priority to somebody? If it is a real priority, then there might be a sacrifice. We can always invest further away, but then that compromise might be we've got to travel a little bit further, but we might find better yields. The amount of capital that we've got to start with, that's definitely a consideration, because we might need to recycle as much as we possibly can to go on and do the next, or we might be in the really fortunate position that actually we've got a lot of money, we're trying to actually get it out of a business and just invest it, and we can afford to be less aggressive with that reinvestment plan. And all of this stuff really does have an impact on what we can be looking at. So the first thing I would say is sit down and really work out what you need from a deal. The deal stacker inside the roadmap is a good tool to do this, but a good simple spreadsheet will do the job. As a baseline, I like to make sure that I'm getting a 15% return on investment on my deal. So I'm getting 15 sort of pence back for every pound I actually leave in all of my deals. Then I like to make sure that I'm earning £250 net cash flow per room. So 5-bed, I'm looking at £1,250 a month net, and that's after all my costs, which is obviously the mortgage, it's the bills, it's the repair and maintenance, and it might be even management costs.
Is that 15% on cash employed, is it?
Yeah, 15% on cash employed, but that's at the back end of the deal once it's all refinanced. So, once everything's said and done, you're leaving a certain amount of cash in the deal. 15% for me on my HMOs in prime areas, I'm happy, as long as we're above that. Usually we do a lot better than that, but that's where I like to be. Some people want to be at 50%. They want to know that they're kind of not leaving any more than 50% of their starting capital in that deal, or getting at least 50% of it back within the first year. Some people want 100%, and it gets increasingly difficult to recycle more capital out of deals. The perfect deal is, of course, we're making lots of cash per room per month. We're getting all of our capital back out of the deal, and we're buying it at discount first, and it's in the best possible location. So we've got really great occupancy. But that is the needle in the haystack. So what we also need to do is combine our investment framework, and this is very much down to you. This is all about what you're happy with, what is acceptable to you, what's going to work best with you and your long-term goals and your family goals and whatever they might be. But we need to sort of break it down from there. So do you have any ideas as to what that investment criteria needs to look like for you, Matt? Have you got as far as thinking about that?
Well, it's only recently, really, that I've thought about unlocking the power of getting investors, like using private investment. Because when I've done flips before, it's always been a struggle. I've used equity that I've had in a house and sold it and moved the family with me, and so I've been always using my own capital. So I've got a little bit of the headspace of trying to get all the money out. That model of adding the value to it that you can then refinance, and I suppose the unicorn deal is to try and get all your money back out.
That's right.
But
yeah.
But what I'm looking at, I can't see it. Once you've done the building works and everything, I can't see how that works. So I think, as you said, you've got to leave some equity in there. But then I suppose, what do you do with the investor then? Are they happy to leave their money in, or do you pay them and leave some of yours? Because then you end up running out of money, or you get a new investor.
So we've got a couple of things going on here. We've got what Matt needs to get from the deal, but then we've also got how we do the next deal and the next deal and the next deal and so on and so forth. And if we bring private finance into the mix, if there's a shortfall on getting capital out of the deal, the question that you're asking is, how do we repay that? So let's make this super simple. You'll have an agreement with an investor at a fixed rate of interest. They'll come in, give you the cash, you do the deal. You're a builder, you've got all these skills, fantastic, could even work as a JV. But at the end of the deal, let's say you end up with 50,000 stuck in the deal. How are you going to pay that back? That's really important, and we need to understand that. Now, unless you've got cash coming from elsewhere that you can bring in from another deal or another refinance, or maybe you're making enough cash every month in your business to accrue this and repay your investor, we need to really think about whether or not it's possible to do this, or in fact sensible to do this in this particular deal. What you might need to do is look for that deal that actually you've got a lot of confidence in recycling all of that investor capital, getting 100% sort of return on investment, or getting as close to that as possible. So what we need to do is we need to be really honest with ourselves about whether or not that deal, that combination of getting all of the capital out, adding value, getting capital out, and being in the right location for tenants and so on and so forth, whether that exists in the location that you're looking at. So what I would recommend you start by doing is, first of all, really get down to basics and figure out what your investment criteria needs to be for your projects to work and for you to be able to continue and actually build this out at the pace that you want to, according to your business plan. Then what we need to do is we need to actually figure out whether those deals exist in books. So the second part to this is doing an area evaluation exercise. This is an exercise of looking at everything that's recently, within the last couple of years, sold on the market and is perhaps currently available on the market that might be suitable for conversion to a HMO. We've got to put some assumption in the model, and with my mentees, and actually this document's available to members of the HMO roadmap, this area evaluation exercise, at the end of it, throws out some data. The more information that we can put into it, the more potential properties that we can, I suppose, analyse, the more data it will throw out at the end. And that average data is a really good indication. And if at the end of that exercise it's looking very much like this sort of 100% ROI deal just doesn't exist, then that's the point at which we need to say, okay, look, this model isn't going to work here. So either I need to change my expectations about what's possible and settle for getting less capital out of my deals or a reduced net cash flow per room, or we need to take the idea and see if we can make it work somewhere else. And we do the same exercise, that same area evaluation exercise, in another town or another city. And for you, that might mean expanding further to the north, because you have naturally got high property values to contend with, and that will naturally squeeze your yields and make it increasingly difficult. Not impossible by any means, but increasingly difficult. So there's definitely an exercise before getting started, before actually trying to go and buy anything, of putting all this information on the table and trying to hone in on whatever looks best for you. And it is a process of trial and error, but this is something that most people don't go through, Matt. They just get started, get into a property, actually find that it's probably not going to stack up the way that they want it. That then hinders them on the next deal, and so on and so forth. The people that I've worked with and the people that I've seen do better than anybody, they stop and they really spend time figuring this bit out. They get that investment criteria and that location, they get it married up, and then they can, with confidence, start to actually get into the properties and start viewing them in this particular location. But a lot of property investment is all about compromise. So eyes sort of wide open, and just me being super candid, it's tough if you're looking for that needle in the haystack. If you are looking for that 100% ROI with a high cash flow, it is tough to find. Often there is compromise to make. And even up here in the north, I compromise in the city centres because I like to be in the very best location, but I know I'm often not getting the very best return for that. What I am getting is a lot of really good rental confidence. So I think, to answer your first question, that's where you need to start, Matt. It's figuring out what you need for your investments, what your investment framework, your investment criteria is, and then drawing a line under that, and then getting stuck into an area evaluation exercise. There's a template in the roadmap that you can go and download, or you can just build one yourself. Analyze as much sort of on the market or recently sold data as you possibly can, and see whether what you're proposing to do, and you've got to plug some hypothetical numbers in, is actually going to be possible within your investment framework. So does that give you a good enough answer to the first question? It's not a silver bullet. There's a lot of work to do, I suppose.
So presumably, if you need to kind of find an investor that's tailored towards that, that's quite happy to maybe leave some of the money in there, that's not looking for a year cash, to cash out in a year.
Yeah, that's definitely an option. If you don't want to compromise on where, and you know that you're going to end up with some capital stuck in the deal, then you need to deal with that. So that might be your relationship or agreement with an investor, where actually you keep a certain amount of capital in your business or in your deal, and you pay them out over, let's say, the next 12 months, the next 2 years, the next 3 years, whatever it might be. The alternative way of looking at this, Matt, is you've got fantastic skills and all of this experience as a builder. You could be a great option, a potential partner for an investor who's prepared to bring the money. And actually your bit could be finding the deals, getting in, doing the refurbs and making it all happen, getting it up and running. Their bit could just be bringing the money. And as part of that agreement, there could be an expectation that we're not likely to get all of the money back out of the deal. We're going to be leaving a certain amount in, and then you figure out between yourselves how you're going to deal with that element that's left in. It could be that it stays there until you next refinance the property 2 or 3 or 5 years down the line. And I've seen and worked with people who've done that really successfully. But that needs the right investor, which probably takes us to your sort of third question today, which we'll come on to, because it's all about how you frame whatever it is that you're offering and who you need to speak to about this. But it's definitely an option. I would say it's not ideal unless you're both completely aligned that there's going to be capital left in the deal, and if everyone's okay with that, fine, that's absolutely great. But it's not how most people would want to approach working with an investor. Ideally, you'd want to be getting your investors' money in, but then out as well.
Right, okay. Within what kind of time frame? As soon as it's rented out? A year kind of thing?
Yeah, which usually sort of, if you're doing a big refurb, usually that's about a year by the time you've got in, bought it, refurbished it, and then refinanced it. But it depends on what your agreement is with your investor. If you guys are happy with 18 months or 2 years, or if you get in and do a deal and make it all work and get your money back out in 6 months, that's absolutely fantastic.
And do you generally pay them back at the end? Do you roll up the interest? And
usually with investors, that's a better way of doing it, because obviously refurbing properties and all the costs involved, it's a lot to stomach. That cash flow element is definitely a consideration. So if you can roll it up and pay it all back at the point you refinance, it's usually a bit easier to manage. But that said, that won't work for every investor. Some investors, if they're just investing on a interest-only basis, they'll want paying back every single month, and it's just about making sure that works for you, having a contingency in place so that you can do that if your investor, if the person that you want to work with, prefers it to work like that.
Yeah.
Should we come on to your second question then? It's the part B of this. How do first-timers get commercial valuations? This is actually a really great question, and it's very pertinent because I've got a mentee at the minute who's got tons of experience in the property industry, but doesn't actually have landlord experience. So there's a couple of things here to be mindful of. Commercial valuations, they are and can be different depending on the lender. So every lender's got a slightly different opinion. I've done a really good episode on the podcast previously with Ellie about this. Ellie, our broker at the Roadmap, and Ellie explained, how most lenders generally look at it. But unfortunately, it's not quite as simple as picking a lender who will value something in the way that you want it, because there are so many other factors. If you don't have the experience, that lender might not be in the market for you. So there may be a compromise to make. So my recommendation would be, first of all, to speak to a very good broker like Ali, who somebody else who knows the lenders very well, and get this sort of advice before you buy the deal.
Does it matter that it's the broker's not local?
It doesn't matter at all, but what's really helpful is if that broker has a sort of a preferred sort of relationship or partnership with the lender. So lenders, for example, like Shawbrook and so on, they have brokers on their panel that are preferred. They get preferential rates, they get to know about changes in products before other people, and they can usually sort of pull a few more strings than other brokers can. So it's really useful to have that conversation about the possible exit scenarios before you actually buy the deal, because getting into the deal, buying it and coming to refinance and then finding out that actually you can't get the mortgage product that you want because you don't have the experience, that is disappointing. So to answer your question, it really does depend on the lender, but it is a little trickier to max out on everything. Let's say commercial valuation at 75% loan to value if you don't have that experience. Sometimes The sensible approach is to do a slightly smaller project that doesn't require as much in the way of refurbs, earn your stripes, get a bit of landlord experience under your belt, and then come back with that experience
with the
bigger one. Exactly, yeah. It can work, but it's definitely more challenging. And of course, we're at a point in the market where interest rates, they've stabilised a little bit, but things are still changing, and who knows what's around the corner. And actually, if that one lender who's got the product that you need, if they come out of the market in the 6-9 months while you're refurbishing your property and they're no longer there at the end of the deal, what do you do at that point? So you're a little limited on options. So again, it's important, especially if you're working with private investors, to make sure that you've considered these sorts of exit scenarios and the risk of things not quite panning out the way that you want. Generally speaking, better to start with a slightly smaller project, earn your stripes, build a relationship, and then come back in with a bigger project.
So for a 6-bedroom, you don't need planning permission, do you? You don't need a planning application.
Well, it depends on whether or not there's an Article 4 direction in place. So if there's an Article 4 direction in place, you'll need planning permission.
You do, yeah.
You'll need a planning permission to convert an existing residential dwelling, so a normal house, into a HMO. That is 3 or more people. If you're proposing to put 3 or more unrelated individuals in that house, that's a HMO, and it will need planning permission. If there's no Article 4 direction, then it's a permitted development, and up to 6 occupants is permitted. But as soon as you tip over that and you want to get a 7th person in, then it requires planning. Yeah. Exactly. There are other things, to get the 6 in, you might need to do an extension or a loft, and depending on where you are and whether or not certain things are in place, let's say there's conservation orders, there might still be things to consider. So it's important not just to assume, to actually get in and do the research. But broadly speaking, unless there's an Article 4 direction in place, you shouldn't need planning permission to do up to 6. Okay, hopefully that answers your point around commercial valuation. Let's move on to your sort of second question then. What do I look for when sourcing a potential HMO in an area? I think I know what buildings work, but I'm unsure as to what sort of area and street would get planning if you needed planning. And how do I tell if an area is preferred for families, or the councils wouldn't want HMOs, so on and so forth. So this is very much about understanding what's happening locally. This, with my mentees, this is something I really encourage them to do. I try and encourage them to become experts in their area. Now, if there aren't many HMOs, that can be both a blessing and a curse. If there aren't many, it makes it difficult to turn to anybody and look for advice or examples, and sometimes you've got to take a bit more of a punt, but sometimes it's quite nice to know that there's probably not a huge amount of competition. So if you can get that confidence, there is a demand for the type of accommodation that you're proposing to create, that's really useful, and you could perhaps be ahead of the curve. In other areas, for example, Manchester, Liverpool, Leicester, Sheffield, there's lots and lots of HMOs, and the good thing is there's lots of people that you can go and turn to for advice, and there's lots of data that you can pull and extract. For example, just walking in and having a conversation with some of the high street agents that do all of the student lettings, those guys are great because they've got all the keys and they know everything you could possibly imagine about HMOs in that city. They can tell you the good streets, the bad streets, they can tell you what the average rents are, they could tell you what the preference is, they could tell you whether students want to do 48 weeks or 51-week contracts, they could tell you when the academic cycle starts, and all of this sort of stuff. So on-the-ground agents are still a really good resource, and if you can frame it and go in and have the right conversation, just be really honest about what it is that you're looking for and hoping to get from that conversation, most people will be quite happy to give you some advice and help you. So that's a really good starting point. I actually recommend that all of my mentees get on the ground as well and actually see and feel what's going on. So for example, where do the young people live? Can you see where they're living? Can you see where they're all commuting to? Can you see them all marching down to the train station? Are they near big amenity sites like hospitals, big Amazon warehouses and things like that? So it's useful to actually get on the ground and see where people are and what's happening at 8 or 9 o'clock in the morning, when everyone's commuting to work. Does it look like lots of young people are out and about? Is it busy? Is it buzzing? Is it thriving? Those are the sorts of things that most people don't do, but actually give you a really good indication as to actually where the people are that you're potentially targeting are likely to live and want to live. Take it a step further and just ask young people if they've got 30 seconds. I'm thinking about buying a house for young people. where would they like to live? Where do people of your age like to live in this area? And actually, most people, again, if you frame it in the right way, be quite happy just to tell you. So, I'm still a fan of getting some good old-fashioned on-the-ground data like that. The other stuff to look for is the amenity sites. Look for clues in infrastructure programs. So council developing the transport links. Are they put a new metro system in place? Are they adding new stops? Things like that are really helpful. Are the regeneration projects? Is there some business centre development? Is anything like that happening? Are there any new employees relocating to the area? For example, in Sheffield, HSBC built big central headquarters, and that's been a really fantastic sort of finance resource with lots of staff which have ultimately become tenants, and those sorts of things are really good clues to look out for. So when you're really getting into the location that you've decided on, that's the next layer. Okay, well, what's happening? Where do people potentially live and work? Let's just think about planning for a second. It's actually really useful once you're figuring out whether or not you do need planning. If it does need planning, the planning portal is a great resource because you can see examples of plans that people have applied for and the opinion of the council, and actually you can learn a huge amount from that. There might be something on your street that someone's applied for that the council have rejected. Find out why they rejected it. If you're proposing to do something quite similar, you've got a pretty good indication as to sort of how difficult you might find it. You could also reach out to a local planning consultant, try and find someone, perhaps someone who has been involved in these planning applications, somebody who could give you advice and professional guidance as to the likelihood of you getting what you want, or exactly how to go about doing it to increase your chances. So finding the right people to help you. We've talked about agents, talked about planning consultants. These sorts of people are really good. And if you can build that power team around you, it'll help give you that confidence that you need to actually go in, buy properties in a particular area. But what I would say, Matt, is that there still comes a point where you won't have everything that you could possibly want. Hopefully you've got a lot of confidence, but there's still usually an element of having just to take that leap of faith. At some point you've got to do it and just trust in all of the things that you've learned.
It's finding the balance between, taking a leap of faith and obviously trying to take a leap of faith in the right directions. You're not stuck with something that doesn't work for and which could scupper the whole plans.
Absolutely, and that's that's the really kind of worrying thing. If you go and do all of that foundation research, if you do things like your area evaluation exercise, if you really bottom out what your investment criteria needs to look like, and then if you get in and speak to the agents, look at what's going on spare room, look at how many rooms are available, look at how many people are looking for rooms. If you speak to planning consultants, and get in the community, speak to other investors in that location, find out who's investing there, what people's experience are. If you get involved in the community, you'll more than likely find people who know some of the answers to some of the questions that you've got quite specifically about that area. And it's all about adding layers and building your knowledge and confidence about that, so that when you do ultimately pull the trigger, you're doing it really well informed and you've got that confidence, you've mitigated that risk. And if you get the product right and you deliver, you do all the basics well, the chances are you'll create a really great HMO that'll attract really great tenants, be very, very profitable, and continue to do that for a long, long time. Because that is ultimately, that's the objective, isn't it? Right? That's the golden egg.
That's the goal. Yeah. Great.
Yeah. Okay, great. Hopefully that's helped answer your second question. Then, shall we move on to the third one? I think this is a superb question. Matt, you asked about any tips that I might have for approaching friends, family, or other suitable investors. I assume you're thinking about raising private finance and or doing JVs?
Yeah, probably raising private finance and possible JVs, if they come up. So I've got a list of quite a few people that probably have some capital, or some people quite a lot of capital, I think. And it's breaking down that boundary of someone that's a friend or family and approaching that conversation in the right way, really getting it off on the right foot.
Okay, it's a great question, and I think what you're saying there is great to hear, because you're thinking about approaching this the right way. So the first thing that I would say to you, Matt, is you have to be super clear on what you need. So again, this feeds back into your goals, your objectives, your investment criteria. Absolutely. It's really important with investors, you're going in with confidence and clarity about what you want. So if what you need is £100,000 or £200,000. Let's be clear on that. And if what you're prepared to offer is, let's say, 8 to 10% on that money, we can be really clear on that. Now, how we actually frame this, doesn't necessarily need to be as black and white as that, but it is important that you have that sort of clarity so that you're not driven and dragged by investors and do something that suits them as opposed to suit you. So that's the first key thing.
Would that be a normal return you'd offer an investor these days with high interest rates? Would they take that risk on for 8 to 10%?
Yeah, so we at any point have up to sort of 7 figures that we're working with, with investors, and we're usually lending between 8 and 10%. I can tell you we're not lending on anything above 10%.
Right.
And there are other things that can make it more attractive and make it more secure, and I'll come on to that in a moment, but definitely 8 to 10% in the current climate I think is really good. With friends and family, it's quite feasible that they might be willing to lend you money at a lower rate because they know you and they like you and they trust you. So, but I think that that's fair. Let's talk about the broader sort of idea of finding investors. I think we think about finding investors as actually going out and finding them and trying to hopefully bumping into people and having conversations at things like networking events. And while that can work, the much better and much more effective way and much more sustainable method of raising private finance is actually to make sure that prospective investors know about you and about what you're doing and know what you can offer in terms of an investment return. Because actually, I think we can be a little bit sort of egotistical and think that this is all about us as potential investors. But actually, when we're offering returns of 8 to 10, maybe even a little bit higher %, that's a really attractive opportunity for investors. And there are a lot of people out there who are really interested in property, who are maybe really interested in the location that you're investing in. Maybe they know it and they live there themselves and they'd like to see people reinvesting in that. And if they are interested in property themselves, this could be a really attractive opportunity for them. It's out of the bank, so it's a bank-beating return. Maybe they've already got other stuff in stocks and shares, and maybe a problem for them is actually that they need to just get a good return on their money. So actually, this could be a really attractive opportunity for other people. And we should, as investors, have the confidence to be able to say that to people. Now, getting that message out to people is the tricky thing. Inside the roadmap, I've got a course actually dedicated to raising private finance that you might want to check out. And I don't want to plug the roadmap too much, but we talk about the CREST model in there, Matt. I'm not sure if you've seen this, but the CREST model stands for credibility, returns, exit, security, and trust. So let's just quickly whiz through them. Credibility is all about what experience and what you could demonstrate you've already done in this field. So for you, fantastic. You're a builder, you've got all this experience of doing these building projects and of having done your own projects and flips and things like that. That is just superb. Not just that, but you've actually run your own business, and everything that comes along with that is very attractive to investors. So for me, that's the sort of credibility that you would be wanting to frame a lot of your conversations with private investors around. Returns, we talked about 8 to 10%. I think that that's perfectly fair. You could give a few different options, and that could be over 12 months, it could be over 24 months. There's different ways. And it's important to be really clear on that with your investors, like I said. Exit scenarios, investors need to know how they're going to get their money back. So is it because you're going to sell it? Is it because you're going to refinance something? What happens if plan A and plan B don't come together? What's plan C? So it's important to have those sorts of things in the back of your mind. These are the sorts of questions that investors will want to ask you. It could be as simple as, if more capital gets stuck in the deal than we hope or expect, then what I would propose is actually over the following 18 months that the rental income that's being generated is first used to pay back your loan. So that's again, just a really quick and easy example. Let's talk about security. Security is a biggie for investors. There's different methods of providing security. It could be a personal guarantee. It could be a debenture on your business. It could be a first or a second charge on the property itself. And it could be a combination of these things. So it's definitely something that you'd want to take legal advice on. If you're going to do a loan with someone, you've got to make sure that the paperwork is right. That in itself is a form of security. If you're doing PGs and things like that, everyone needs to know. So instructing a good solicitor, a good commercial solicitor who understands this stuff, really easy for them. They'll have all the templates. They'll sit down with you and be able to walk you through this whole process. But offering and being able to offer that sort of security to investors is really good. Now, you've got to remember that if you're trying to combine working with an investor in private finance as well as a bank and getting a mortgage from a bank, there is going to be a bit of a grapple as to who gets the security. The bank are definitely going to want the first charge security.
Yeah.
So you've got to figure out whether there's a second charge left. But you might find an investor who's actually okay without a charge and is comfortable with perhaps just a personal guarantee. So definitely an option. So on your security bits, there's a number of things that you can look at, and that's a good way of doing it. And then finally, your trust element. Trust, I think, for me, is the biggest thing and most important thing here. People invest in people, Matt, and even with all the experience in the world, if someone doesn't trust you, then they're not going to invest. So when you're having these conversations and you're walking people through things and you're going through the process of looking for deals and sharing stuff, being completely sort of honest and transparent about everything the whole way through is the single most important thing. If you haven't done a HMO project before, tell them. If you're not quite sure what the end result will be and you hope it'll be this, but there's a possibility it could be this, be completely transparent. Investors appreciate that, and actually there's nothing worse than getting to the end of the project and having sort of kept some of the detail out and then having to answer those awkward questions with investors. So that CREST model, really, really important. There's a few ways of actually putting that into place. You could create an investor deck. That's a really good way. You could put stuff on your website. You could start building up a presence on social media, talking about what you're doing and sharing it, and talking and showing prospective deals and things like that. So there's a whole sort of Pandora's box we could kind of open on actually how to get this information out and in front of the public domain. But those are just a few. Getting to networking events and doing things like that, they are good opportunities, but it's important that you've got all of this stuff happening in the background, because just expected to turn up at a networking event and bump into someone and ask them for some money, that's not the best way of trying to raise private finance.
9 points of contact.
Absolutely. And I'm a huge believer of that, actually, Matt. That's served me in really good stead over the years, actually. Sometimes you meet someone and then you have a coffee and you have a call and then you do another meeting, and it takes time.
Just don't leave it to 129 points of contact.
No, at some point you've got to take the action, you've got to pull the trigger, and you've got to be brave enough to say, look, are you in or are you out? Hopefully the conversation doesn't have to happen like that. But, savvy investors, they get it, and also they're not there to waste your time either. If they're serious about it, they'll let you know, and it's good to be aware of this. So does that help? I know it's a bit of a whistle-stop tour on sort of raising finance, but does that help, Matt?
Yeah, massively. Yeah, lots
Fantastic.
of good points in there to take away and go through.
So just kind of to summarise everything today then, and to give you some action points to go away with, what I would recommend you do next is, first of all, try and really sort of hone in on where you actually want to invest. So go and figure out that investment criteria based on your short, mid and long-term goals, and actually figure out what you need to get from your deals. Then do an area evaluation exercise, get a load of property data into a spreadsheet, figure out what things are worth, what things are likely to generate in terms of income and revaluations, and look at whether or not your investment criteria is likely to be compatible with that area. If it is, great, it's time to start doing some viewings. If it's not, let's open the search field. Let's look at the next town or the next city and see if we can find a better location. The extreme is it's not working anywhere near where you are, and the compromise might be moving elsewhere in the country, several hours away, because the returns are there. But there is a process that you can go through. So I think two really key and clear action points there. I think when it comes to figuring out commercial valuations, start by having a conversation early on with a good broker. So figure out, before you get into a deal, what the exit's going to look like and whether or not you, with your experience, are going to be able to get onto those commercial valuations. That's a really critical part, so make sure you do that.
Is it okay to get in contact with, is it Ellie or Ella?
Ellie,
broker? Yeah, she welcomes other business, obviously.
Absolutely, she certainly does, and Ellie understands that there is a process to this, and Ellie will be able to give you a bit of that advice. She'll be able to have a chat with you, look at your personal circumstances, just give you some broad advice, and then you can go away with that. And then I'm sure if things are going well, when you've got the deal, then you'll be able to give Ellie up, and you can just pick up where you left off. But absolutely,
yeah, great.
Getting on the ground then, once you've figured that area out. Get on the ground, look at what's going on, figure out where those local amenities are. Try and speak to local agents, speak to existing investors, look at spare room, try and get hold of as much data as you possibly can to figure out where young people that you're targeting actually want to live. That's really, really important. And then finally, in terms of raising private finance, start talking about what you're doing. Think and remember the CREST model and build all of that information into the conversations that you're having. Maybe think about putting an investor deck together. Start getting some of that out on social media if that's an environment that you're comfortable in. But more important than anything else when it comes to all of this is taking the action and then consistently moving forwards, putting one step in front of the other. Because a lot of people do this and they find that there's a snag or an issue, it's not quite working, and they give up. And actually, there are opportunities out there. There are great opportunities out there. And if you just commit and you just keep stepping forwards, I'm confident that you'll find it. Even though you are living in a more expensive part of the country, I'm confident that you could still make this work really, really well. Whether or not it's in books, well, we'll wait and see. But even so, you'll definitely find that there is going to be a great place to make all of this work. Great.
It's hard finding out what the councils, what their attitude is towards HMOs. Do they like them generally, or do they? Or
No.
Do you have to fight? No, they don't like them.
I think generally speaking, the councils don't like HMOs. My experience is that you need to know where you stand technically with them. So planning is very technical. And my recommendation of getting a good planning consultant on board, I think that's a really important one if you are proposing to go up against the council, if you are going to apply for planning permission. But what I would say is, look, if you can do this without having to go and jump through the hoops of planning permission, if you can find an area where it is permitted.
So out of Article 4 and like a six bedroom. Right, okay. Yeah.
Exactly. It's just going to be much easier. Yeah, exactly. Yeah. But again, boils down to where you want to invest, that plan. If you want to invest in student accommodation, there's very few places in the country where investing in student accommodation isn't within an Article 4 direction because it's so central in a city centre. Yeah. So, Matt, plenty of food for thought there. Thank you so much for coming on the show.
Thanks for having me.
No, I'm looking forward to seeing how you progress. Keep us updated. Drop into the community and let us know how things are going. And if you've got any more questions about anything that we covered today, come and ask them there, and I'll do my best to sort of.
Yeah, I will do. I did join the Facebook group, which is really great as well. That's lots of a wealth of knowledge on there as well. So that's been helpful.
Fantastic. Well, look, I want to wish you the best of luck with all this. Thank you for coming on the show. Thank you for being brave enough to come and have this conversation on the show in front of all of our listeners. It's been an absolute pleasure. Thank you so much, Matt.
And you. Cheers,
best
Andy.
of luck.